Clearly big sell-off and volatility both yesterday and of late. Does the fundamental data in the U.S. economy give any reason for that over the last few weeks?
I don't think the data is really driving it. I think what we have here is two things. One is U.S. policy, which is the Fed continuing to tighten and pushing up interest rates more broadly. Markets are adjusting to that. And I think the second thing is U.S. trade policy that has been moving more aggressively on China. Those are things that the U.S. has been doing that I think affects equity markets. The other thing I think that is in the mix here is what has been disappointing data outside the U.S., disappointing data in Europe, disappointing data more broadly, I think, on where CapEx spending is in the middle part of the year. So I think there's a macro part, a policy part here. The question is whether the markets themselves are going to start to become a direct influence on the macro picture. We don't think so, but obviously we haven't seen how this story plays itself out.
Clearly the trade tensions don't just potentially affect the U.S. economy, but the world economy, and China in particular has been in a lot of focus, and the Chinese economy, of course, has the ability to drag down the global economy. Can China kickstart growth again if it needs to? Does it have the tools at its disposal if necessary?
Well, I think they can. I think we've seen their ability to influence macro performance through policy is quite substantial. I think the question is, first of all, whether they are moving aggressively enough against the backdrop of the trade drags. And I think the second issue is whether the timing is going to be aligned, whether we will see the stimulus kick in at the same time that we see these drags building. Right now, I think the Chinese data is pretty ambiguous as to where we are. The third quarter downshifted. Where we are September, October is, I think, very mixed in terms of what the data is telling us right now. We're hoping to see stabilization over the next 3 months as some of the policy stimulus begins to kick in.
Well, and you mentioned Europe, the data's softened there a little bit. What about the rest of emerging markets? Is it as gloomy as some people suggest?
Well, I think there's pockets of real gloom. Some countries that are actually in recession now, with Turkey and Argentina, a couple of other countries that are weak. And then you have, I think, a good part of EM, the other Asian economies, a lot of Central and Eastern Europe, which are doing okay, but are certainly being affected by the softness in the euro area and generally the softness in manufacturing. So I think it's a very mixed bag in EM, and obviously politics is very big in the agenda. In some places, Mexico, Brazil, and a few others are interesting right now.
Mm-hmm. Bruce, back to the U.S. Clearly, the equity markets have taken the brunt of some investor concerns of late. What about in the credit and debt markets? Is that showing the same level of risk sentiment?
No, and I think this is really important, especially when we think about the Fed reaction function. We think the Fed can have a high degree of tolerance for equity market adjustments if they don't spill over to other markets. And we have seen some widening in spreads, some small movements in funding markets, but nothing that we think at this point gets the Fed attention. And I think that's a really important thing to watch here if we want to think about how the Fed is going to deal with a shift here going on in the equity market.